You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, let's keep the theme going here. We've been talking, as usual, about plays that are inside the Options Playbook and when might be an optimal time as far as option pricing is concerned to look at strategies in specific underlyings. Today, we're going to look at an S&P 500 trade, the good old SPX, and it's been noted by a few analysts that if you look at a weekly chart in the SPX, that for 9 weeks in a row, the bar was green. In other words, it always finished to the upside, and that's just a very rare occurrence in the S&P 500 index. It's not necessarily the most rambunctious marketplace that we've ever had, but it is definitely worth noting to have that many weeks in a row. And we're finally getting a little bit of a downturn. You just make sense that when the markets get a little bit overextended to either the upside or the downside, that eventually they have to come down. Most markets don't go straight up. So today we had a little bit of a down day. We are taping Options Playbook Radio on the 6th of March. It is a Wednesday. The markets are closed. The S&P 500 index was down 18 today, and the last trade was $2,771.41. But what makes me more interested in the downturn in the S&P 500 index is the VIX has been hanging down around the 12 or 13 range. It actually got to the lower end of the range as far as this year is concerned, 2019, and we had a spike back up. And today the VIX closed up a mere dollar, but it was up, and it closed at 1574. I personally, in the S&P 500 index, would rather trade the VIX, rather trade the index, I should say, when the VIX is above 15 as opposed to when the VIX is below 15. It's just a nice type of volatility based on the index as far as the option premiums are concerned. So we get a spike up in the VIX. We're going to go to the S&P 500 index. We got maybe a little bit of that downturn, a little bit of the little overdone to the upside. Maybe we want to do something a little bearish to the downside. And because we got the spike in the VIX, I like to talk butterflies. So we've been looking at a lot of earnings trades, and recently done some diagonals. We even did a Christmas tree, a 1x3x2 butterfly over the last couple of weeks. So we're just going to go back to the old standard butterfly, a good old 1x2x1. We're going to do it directional. We're going to be bearish on this trade. We're going to go out a very short period in time. As a matter of fact, a friend of mine always calls these time bomb butterflies when you do them extremely short and you do them in a direction. Because the one thing about a butterfly is you are selling two option contracts at a strike price that you want the market to go to. All right. Now, here's the reason why some people like to do them short term. It's a little bit more speculative. You kind of need that move to the downside. But the biggest reason why you do them short term is that if the market does come down to your strike and you are correct on your forecast, what you're going to have is an at-the-money option contract. And in order for a butterfly to max out, that contract that you sold, your middle strike, really needs to go to zero. You need as little time premium as possible in that option contract to make the maximum you can on your butterfly. And in an index like the S&P 500 index, that really only occurs at expiration. It's a $2,700 index, and because of that, you're just going to have premium just in general. We throw in that the volatilities are up a little bit all over the marketplace in general, and you just have expensive options. But bottom line is, at expiration, the time premium has to go away. So, since we're taping on a Wednesday, we are going to use the shortest term option that's available, which is a Friday expiration. So the expiration date here is going to be March 8th after the close. So this is a weekly option contract in the S&P 500 index, and it's important that it's a weekly because weeklies actually trade the entire day on Friday. They are PM settled. So that means you have 2 full days of trading. The VIX is up, so usually butterflies, when vols are up, in general, I don't care about if it's an index or a stock, butterflies become cheaper because you're selling those 2 option contracts at a strike that you want the stock to go to. So a lot of times butterflies will cheapen as volatility goes up, and they will deflate as volatility goes down or as time decays. So there's two whammies that could happen to help you out with a butterfly. So it's going to be a very simple, straightforward trade today. We have the index at 2,771.45. Our short strike is going to be about 20 points, which is about what the market actually went down today. So we're going to be buying the March 8th expiration, 2 days away, 2,770 strike put. We are then going to sell the 2,750 strike put, and at the same time buy the 2,730 strike put. We're going to do this as a 1 by 2 by 1 unit. That's our butterfly, and that is currently trading for a net debit of $2.80 to the account. So we are going 20 points wide, and we are paying $2.80. Now, I've looked at this trade a lot over time, and when you're going up approximately this amount, 20 points, and you're doing it on a short-term basis, anytime you can pay under $3 for that, that usually means the implied volatility index is up. It's the only way that you can do it. So, hence, when we talk about Options Playbook Radio, we never talk about anything as a recommendation. We're just looking at certain instances where pricing may behoove a particular one strategy over another strategy. If volatilities are up and you just want to buy a put, for example, those puts can be very expensive in that underlying. So if I just look at the 2,750 strike put with 2 days remaining, 20 points out of the money, that's trading for $5.50 for just that put to buy it outright. If I want to do the butterfly, I can, and I have that same type of forecast. Why not? With a short-term expiration like that, why not cheapen it by going and doing a full-blown butterfly and bringing the cost down to $2.80? So, what's our max risk? Well, if it's a debit butterfly, and with most things that are a debit, that's usually your max risk for this type of trade. So in this instance, it's $280 for every 1 by 2 by 1. Don't forget to add commissions on it. The maximum upside is 20 points, the width of the strike, minus the $2.80, which is $17.20. Now, if you get that $17.20, you actually should get the stupid reward right along with it. And why is that? Well, you should have been out of the trade. If you stick around and the market is at $27.50 and you just decide to hold off and hope that at expiration it goes out right at 27.50, well, that's a good thing for the trade, but you should really get out of that trade well before that. So you're not looking to try to hit a home run where I'm paying $2.80 and I want to make $17.20. That's just really not fathomable. So if I put this on for $2.80, market starts going my way, ideally it would trickle down towards that 27.50 mark, and as the Friday close comes in, it finishes somewhere in that range. But if I ever get an opportunity to get out at a double or even more than a double, so I could sell this for $5 or $6 or maybe even $7, and you don't take that, well, that just doesn't really make sense. Now, on the downside, you do have the limited risk of $2.80. If the market goes against you, that means that the market starts going up. There are alternatives here. A lot of times you can even roll butterflies into credit spreads. We have done that before, where we will sell the most at the money option contract, or the closest to the money option contract, and then buy the further out of the money option contract as a hedge, hence creating a 20-point wide call credit spread. So that's an alternative, and that's one thing that we can do on the trade, or we can just say to ourselves, you know what, if we're down 50% on this trade, we're just going to get out, which would mean $1.40 on the downside. So I'm looking for a double if I'm correct on the forecast, and I'm looking to get out if I lose about half of my money on this trade. But by doing the butterfly, we've already reduced our risk as opposed to buying a put option outright. And that's what butterflies, that's why we call them a time-bound butterfly in this instance, in that if the market does go down, that 27.50 strike put, that value of those option contracts has to go to zero because time is decaying. So let's recap. We have had a bunch of up days. So we also had a little bit of a down day today. We saw a little bit of a spike in the VIX today. So we said to ourselves, let's look at the S&P 500 indexed weeklies. It is Wednesday. The markets are closed. It is the 6th of March. Based off of where the market closed at, $2,771.45, we would look to go on out and buy one March 8th expiration, 2,770 strike put, sell two March 8th expiration, 2,750 strike puts, and then buy one March 8th expiration, 2,730 strike put. Do this for a net debit at the midpoint. If we can get a midpoint fill, it would be a good fill at $2.80. Our maximum risk would be $280 plus commission. The maximum upside is the width of the spread minus the debit paid, or $17.20, or $1,720 less commission. And we're just going to see what happens. We got an alternative. The market goes up, but the market goes down. We just need to get out of the trade. We don't want it to go too hard against us, and we don't want to get too fancy with it. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.